Everyone to Financing of Risk. I'm Rich Rudolph, your ed consultant for this program. Our speakers, see David Hershey is eagerly waiting to get going, which I'll talk quickly so he can do that. And then tomorrow, Wendell Boson will be joining us. The person who will keep us all connected and answer all those technical questions is Ted Kinney from the Alabama Independent Insurance Agents. So with that, we're kind of ready to go. I will give you an advance warning, as some of you are, because I saw the list. I am in a tornado watch, so if I disappear, hopefully it'll only be momentarily and I can hop on the phone, but just in case, always be safe. We can always redo a program. We can't redo you. So now, obviously, we're starting right at the appropriate time today. We'll run 8 to 12:15, have a 1-hour break for lunch, and then finish up at 5:15 with then an exam briefing, which is optional. Those of you taking the exam, we strongly encourage you to attend. If you're not taking the exam, you're free to go. Of course, we all have breaks every 10 minutes. Then tomorrow, it's an easy 8:12, 1 to 5 with a very short exam briefing. Again, optional. I'll give you the number of questions, the number of subparts, and the points per section. But I can tell you right up front, you can just figure an average of 25 points for every 2 hours. So we've got 2 hours, 2 hours, and 3 of 4 hours, 25, 25, 50, 50, 50.
Pardon me, Rich, for butting in, but your microphone is rubbing up against the wire. Yeah, there you go. So yeah. And there's the extent of my IT knowledge.
Well, I also learned that I am right-mouthed, so the microphone should be on the other side because all my cords are stretching across instead of laying there. I didn't think about, you don't think about stuff when you buy technical stuff, like how's it going to fit on your head.
Yeah.
We are using an older version of GoToWebinar, so some of my slides will not be, we've got one thing for the new GoToWebinar, but we've got using an old one. The important thing is for what you folks care about is identifying where the question box is, and up on that little tab, there's a little thing that says view, and that gives you a drop-down menu that has questions, handouts, and chat. Handout is an important one for you because that's where the learning guide is. Those are the most important things. If you lose connection to something, this is where you would go to audio and see if I can find the audio section there. It's on the drop-down menu. Click that, and that gives you a phone number to call in. Or you can get a hold of Ted, and maybe he can repair it. Depends what's happening with it. So that's the important thing to remember there. It doesn't look this way on your screen, but that's the mechanics. You go to the button that has the phone call under audio, and that takes care of that. If you have questions, you can fire those in the question box that's on the drop-down menu. Technical questions, Ted will handle. Questions about the content, David is really good at monitoring that, and I'm his backup, so we'll make sure any questions you have there are addressed. Polls are required for state CE credit and for Alliance updating, so you'll get those. It does not matter if you say yes or no. What does matter is you click submit after you check one of those things. You should receive some sort of a confirmation. So we'll see how that's going to go, because Ted is going to launch the first poll right now, which is it's a real poll, but you can see how it looks on your screen. And then all you have to do is click the appropriate yes or no and submit. And after roughly 30 seconds, or if everyone is very quick on the trigger and clicks it all, then Ted can take it down. And you'll see 2 more of these in this hour sometime, and then 3 every 2 hours in every hour section after that. So it's really important to keep an eye out for those polls, because we have no way of knowing if you answered or not. If you think you missed a poll, shoot a question off to Ted and he'll take care of that. But we can't. Ted or I or David, none of us can tell if you actually logged it in. So just to be safe, if you think something went goofy, fire a question box off. The same is true for updates. So keep an eye out for that. We do cover a lot of information, and hopefully you're looking at the learning guide and the screen and listening and taking notes and all that stuff. So it is truly multitasking. So just be very cautious to keep an eye for those. Your dashboard, this is the same when you log in at riskeducation.org. The important one for you now, since you've already enrolled in this, is to find additional resources. You go to your profile, you log in, go to your dashboard profile. At the bottom, you'll see a box that says documents, and there's additional resources there. There's learning guide, there's other stuff. So you always want to check that to see what's available. It does differ a little bit by the courses, because each course has a little different need. When you go to documents, you'll see this course material and a little screen. You find the course that you're currently in, and off you go. This is also important because you can review the webinar recordings, and this is how you would find them in part of your study. So it's all based on going to your profile and the dashboard, looking for course materials. Course history, you should have already requested or declined state CE credit, but if you need to check, you'd find that in course history. Once you do that, everything is automatic after that. You should get a certificate 7 to 10 days after the course closes. If you don't, then track down the nice folks at the Alliance and they'll see what's going on. This is important for you taking the exam, because this is the same screen where you request a proctor. We'll talk about proctors more in the exam briefing, but that has to be done before the exam window opens. That'll be next Monday, whatever the date is. We'll talk about that specifically. So keep that in mind. For those of you living in Florida, Michigan, South Carolina, or Wisconsin, there is one other document. If you have requested CE credit in those states, there will be an additional pop-up button called affidavit, and you have to click that. But it only applies if you're getting CE credit in those 4 states. It's only available the last day and 3 days after, so don't worry about it now. Worry about it tomorrow, and then Friday, Saturday, and Sunday. That is a separate form you have to complete, though. The learning portal is how you get to course history. Find your course. That tells you all the stuff you need to know to take the exam, your proctor info, some forms for you to sign the final exam. You do not need to take the exam if you have the designation or if you are not pursuing the designation. But if you are looking to become a CRM or to finish off the CIC with this as an option, you do have to take the exam and successfully pass it. So it's important to go to find that and know how to get to that when it's time. It looks like this on the screen when you click that. Final exam is down at the very bottom. It is digital. It's only open for 4 days. I think it's the 16th through the 19th. If you want to take it just for fun, you can. Speaking of the exam, it's probably 20 questions, maybe 21, maybe 19, 2.5 hour time limit. You get 1 shot per course. You do need a proctor to make sure that everything is kosher. The exam window is the 16th to 19th. It is available during those times. Your options for proctors, we'll talk about more later, but you can have an online service. You can go to a brick and mortar testing center, a local Big I, if you're a member. My lights just flashed, which is always scary. Flashed again, okay. I'll talk quickly. A HR department, if you work for a large organization, they can be approved as a proctor. You will get evaluations after each section, and then there will be a final evaluation at the end. We do encourage you to take a few seconds, doesn't take long to do this, and give us feedback, particularly on the last evaluation with the suggestion of, hey, we need information on this. Why don't you tell us how this stuff works? Here's a new thing that's coming down the line. Help us understand this. That's how we keep the courses current and available, not current and updated to give you the best information you can for purposes of practicing your profession. That one has a different format and many more questions, but we really do like those. This is the only advertisement you'll see, a non-paid celebrity endorsement. I wrote this book. I don't get anything from it. I donated it to the Alliance. The proceeds from it go to the Jerry Montgomery Memorial Scholarship Fund. Jerry was a longtime faculty member and staff member of the Society for CAC and passed away way too early. It's kind of the backstory of insurance. It's not a technical book like the learning guides that you'll see or the CIC courses that you take. This is the backstory. How did we get to where we are? It's full of just weird stuff, funny stuff, stupid stuff, but it's a serious research, so it does give you the backstory. Hard copy's $25. If you're a dues paid member, you get a freebie as a digital download. So we hope you enjoy this program. I am getting ready to, David, you can go ahead and start setting you up. David Hershey, CRM, CPCU, ARM, SPSR, AMIM, CRIS, MLIS, and probably I'm missing the EIEIO. David is a corporate risk manager for two organizations that are related, Sprague Operating Resource, Lexa International. They do about over $140 billion domestic and international, all sorts of strange things. We were chatting earlier about the impact of the conflict in the Middle East and how that is affecting marine insurance. David is, that's concern to him because his organization is involved in petroleum wholesaling and distribution. So there you go. You might hear more about that today. They do wastewater treatment, equipment, lumber recycling, medical product manufacturing, residential water purification, softening equipment manufacturing, college student housing, telecom, petrochemicals, food, lifting equipment manufacturing, pump manufacturing, bearings, transmission, auto parts, and you name it, they're touching it. In a former life, he was the risk manager for a very large auction house and a military contractor, written a number of articles, does a lot of teaching for us and for other organizations, and is happy to say he did not suffer any injuries because he competes on the senior skiing tournament circuit. Every now and then he picks up some hardware. He hasn't shown us any yet, but the hardware is what you put on your shelf, not what goes in your body, which is always a good thing for a skier. David, they're all yours.
Okay, thanks, Rich. Hadn't really thought about the hardware for a body part, but at any rate, can I just get somebody to say you can see me and hear me? Okay. Oh, okay. Let's see. Yep, great, terrific. Thank you so much. Okay. It seems like we have the mouths covered. Rich indicated earlier that he's a right mouth person. We're waiting on the left mouth, but I would probably fill the role for the big mouth. Okay, so I want to stress that, I'm on the buying side and I actually implement a fair amount of programs through all of our companies. And so as we're going through this, I'll give you the material that you're going to be tested on, but I'm also going to spend a little time, which frankly I find probably the most interesting part, of how these types of learning criteria really affect the industry from my perspective. So a little bit about us. Our risk management office is in New Hampshire. The main office for the Americas and a portion of Europe is in New York City. Our European portion covers the rest of the world and the rest of Europe for what we don't cover in the Americas. So we're about, I'm going to say plus or minus 50,000 employees, ballpark. Our budget here in the US for risk management depends on the year, but we're somewhere between 8.5 and 10 million a year for our risk management piece. Okay, so that includes risk transfer, includes claims. We place about 200 insurance policies every renewal season, and those are usually, the primary casualty. We have a bunch of one-off specialty policies for precious metals, for the medical products group, medical liability, professional liability, pollution liability, and so on and so on. All right. So at any rate, enough of that stuff. Okay. So as we go through this, if you have questions, my preference would be that you ask them right away. All right. If I don't get to you right away, I may not be seeing your question. All right. So at any rate, don't take that personally. I will come back to it. It's my goal to answer all. All right. So that being said, we're going to talk about risk financing fundamentals. I think everybody can agree that risk financing, in the very basic sense, is premium payments, right? If you're workers' comp, GL, whatever it is, exposure times rate equals premium, and the insurance company does it all. Okay, as an insured, we write a check for the premium installments or upfront. Then we're off to the races. Okay, so sometimes that's not the most optimal approach. Some of our programs, our deductibles are anywhere between 50,000 and 5 million, okay, on a deductible. So, or self-insured retention, again, that varies as well, okay. And we make those decisions based upon what's most economically viable for us. So as we go through this, keep in mind, I'm always looking at it from a perspective of, is this the best program for the customer? And my response on that would be maybe, okay, but the customer is going to be the one that's going to be in the most informed position to really make that decision, so long as you give them the tools to properly assess that risk and the cost versus benefit analysis. So great. So throughout the process, we're going to have goals. Those goals will probably lend themselves to be the test material. So we're going to want to address those in a little bit of detail, make sure that you feel comfortable with those. Now, just so you know, there's always that little bit of a trade-off when you're doing these classes between, one style is just reading one slide after another. Okay, and you folks are all literate, you can read the slides on your own. However, the stuff that I choose to read will be the stuff that I think you should anticipate on a test, okay? And then I will digress from that and look to incorporate the goal, learning objectives into the real life application. So this section will provide participants with fundamental information on the risk financing process. Financing terminology will be reviewed, as well as the most common financing options. Okay, and the key here is plural. It's options. The use of reinsurance will also be discussed. And for just so you know, we have a fair amount of reinsurance relationships that we look to foster on that. And if you're approaching reinsurance directly, there's a handful of miscellaneous but yet very specific endorsements that you're going to want to see attached to a typical reinsurer's policy. So these are going to be our key objectives. And as I was saying before, yes, we're going to read these. So we're going to define the risk financing terminology and identify terms when described in real world scenarios. Excuse me. We're going to compare and contrast the perspectives and identify insurable risks from the points of both the underwriter and a risk manager. Explain the most common financing options available: retention, contractual risk transfer, and insurance. Let's see. Now, on insurable risk, Rich was saying a little earlier, with the turmoil or war, whichever the proper terminology is, regarding the Mideast, we're facing, significant problems with that, because, and you talk about the weirdness of things that you would never discover until you get the phone call at 3 a.m. in the morning from a shipper in Oman, okay, who is loading a vessel. And we have, 4 hours earlier than that, 10 o'clock at night, you get an email saying, hey, cargo insurers are terminating coverage, in 24 hours regarding the peril of war, civil commotion, and riot. Okay. So, they do underwrite, depending upon the cargo, and guess what? For an additional premium. Surprise, surprise. However, that gets complicated because one of the things that they use for underwriting criteria is the tracking device that are on the vessels. Well, when they go through the Strait of Hormuz, many vessels turn off the tracker. Now, it's not like an Apple AirTag, okay? It's similar in principle, but it really enables other vessels to stay clear, okay, of a vessel you can't normally see. Maybe it's nighttime or something of that nature. But that's one of the criteria underwriters use in pricing, a 36-hour, premium or reinstatement of the excluded perils. Well, a lot of vessels now are standard practice turning off those trackers when they go through the strait. So, again, things that you would not normally anticipate, but adding a complication to that, and yes, sleepless, restless evening associated with that. We're going to explain the retention and external financing diagram and the role in making a risk financing decision for an organization. We're going to describe the basic types and forms of reinsurance and apply their uses to real-world scenarios. Okay. Now, as agents and brokers, to me, I think probably the most interesting and perhaps the most overlooked section of our industry is what we refer to as a real-world scenario. And as an agent or a broker, you step foot on a prospect's property, you have a conversation, let me take a look at your current program. Well, that doesn't necessarily address the buyer's real-world scenario. And sometimes having a deep conversation with the exposures that individual companies face can be quite different than that which is contemplated on their existing insurance program. Okay, so can't emphasize that enough. Because it's impossible to avoid or control all risk, okay, unless you're bankrupt, okay, there must also be a method of financing. Insurance is an important part of most risk management programs, and it is relied upon heavily by organizations as a source of providing external funds for financing risks. Now, I would also add one other component to this. It's relied upon heavily by organizations, not only as a source for providing external funds, but also compliance. Okay, don't underestimate or understate the importance of compliance. I will tell you, we have some of the most bizarre, ridiculous endorsements on some of our programs strictly for compliance. No other reason than that. But when you have a $5 million deductible with a policy with a $5 million limit, so it's fronted, okay, the underwriter doesn't care. Now, you can put on that, we're going to insure, the CEO's dog, okay, and underwriters don't care. Okay, they charge you $100 for the paper processing or not, but again, don't care at all. The key is you've got to be compliant. Okay, can't emphasize that enough. A lot of times, agents and brokers may be looking at a prospect, excuse me, or a renewal, thinking, is it the best economical program? Well, yeah, okay, but maybe the other side of that question to the buyer or prospect is, do you have any weird contracts that impose upon you the need to do something that seems a little bit out of the normal stream of commerce? And if the answer to that is yes, maybe you can cover it with a manuscript endorsement, so long as the deductible or self-insured retention on that policy is substantial enough that the underwriter does not really perceive a risk for issuing and attaching a manuscript endorsement. But that takes the normal prospecting and renewal quoting process and sets it aside a little bit to make to cause a larger conversation, which may be more likely to solve problems. So let's talk about some of the terms. Insurance is one of those things that I have to tell you, okay, even with larger brokers, sophisticated brokers, it amazes me how some terms are thrown around, okay, relatively arbitrarily. And from a denotation, I mean, a strict definition of the term, they're being used incorrectly, okay? And the two things that I see on a regular basis, okay, is number one, a self-insured retention is quite different than a deductible, all right? And sometimes those are used interchangeably, and they are not. The other one, okay, and this just baffles my mind, but I will tell you, I still see it. And it frustrates me so much, I can't even bring myself to argue it. Okay, now, just so you know, I probably spend 6 hours a day, okay, arguing, okay? But the other one that I get from agents and brokers is a certificate of insurance. So I would call this for us an incoming certificate. So we would review it through my department, is it contractually compliant? Okay. And the key component is workers' comp. I will often receive, often meaning, once, maybe twice a month, okay? So certainly with some regularity, okay? That for workers' compensation on a certificate, you have other and statutory. So I often see the other box checked, okay? And then the employer's liability limits, 151 or whatever, whatever those are, okay? And so, of course, from our perspective, well, if it's other, what is other? What are those limits, okay? And so you go back to the person that generated the certificate and they say, well, it's other because, it's 100, 500, 100. And you go, okay, wait a minute. They're two different and separate coverages, okay? They are not related. And then you have an agent say, well, yes, they are. They're on the same policy. Okay. And it's like, okay, you wonder, are you licensed? Okay. So hopefully we don't have anybody in this group that thinks employer's liability limit is the same as workers' comp. Right? So we're going to define key risk financing terminology and identify terms when described in real world scenarios. Okay. Now there's a great book out and it's published, I believe, by Ermi. And it's the the dictionary of risk management terms and definitions. Okay, and I don't know, it's probably $50. You can probably get it on Amazon. Okay, I can't recommend that book enough, because at the end of the day, that's the definition that you take into court, right? So at the, it's the answer, and at the end of the day, everybody relies on it. So I would encourage you to, get one for your personal library. Let's see. So those are our terms. Okay. Now, here's some other terms that are sort of thrown around. We want to know the differences specifically and precisely. The differences between written premium, net written premium, and earned premium. So written premium is the total premiums on all policies written by an insurer during a specified period of time, regardless of the portions that have been earned, right? And earned is going to be defined below, so I'm not going to spend any time on that piece. Net written premium, the total written premiums minus premiums ceded to a reinsurance company, plus any reinsurance assumed. And again, we're going to get into specifics on that. Earned premium, the amount of premium that has been used up during the term of the policy. For example, if a 1-year policy has been in effect for 6 months, half of the premium has been earned. Okay? So again, I can't emphasize it enough. These are specific definitions, and you're probably going to want to know these word for word, okay, if you're going to be taking the exam. Unearned premium, the amount of premium remaining after deducting the earned premium from written premium. And then incurred losses, the total amount of paid claims and loss reserves associated with a particular period of time. And then we have paid claims, case reserves, and IBNR reserves, okay, until ultimate claims are reached, at which time there is no remaining IBNR, incurred but not reported. Okay. So paid claims, I think, is easy, okay? It's as the name implies, okay? Paid losses, the amount actually paid in a loss during a specified period of time. Incurred but not reported represents the liability for unpaid claims not reflected in the case reserve estimates. Now, what we're talking about here is not one specific claim, but the aggregation of all claims, or that which you would normally expect to see on an account loss run. All right. Now, I will share with you the IBNR is a factor, a percentage, and that percentage can vary. Okay? You can get that percentage from the underwriter. You can get it from an agent or a broker who in turn gets it from an industry standard, AM Best or somebody else. Okay, that's the only one that comes to mind immediately. But then the third one, okay, is the insured. Okay, I know some of you folks might be rolling your eyes if you're not asleep yet. Okay, but we ran into this issue on a major arguing, probably took 6 months. Okay, and I can be persistent at that. Okay, and that was the IBNR factor that the underwriter provided was much greater than our actual IBNR, because I keep all of those numbers. I keep all of our losses, all the developments, all of that stuff. And so as an example, our IBNR was 0.05%, okay? The IBNR from the insurer was 12%, right? Big difference when you're looking at reserving, reserve claims in the aggregate of, $4 million of claims. Right? Now, you're talking real money there, right? So don't presume that when the underwriter says, well, here's the IBNR development. Yeah, okay, that's nice, okay. but why are we using yours? Now, of course, you want to do the calculation first so you don't argue the wrong side of the fence, all right? So if your insured IBNR, their numbers are lower, then yeah, you argue that. But if your insured ends up to be higher, okay, well, you know, pick a different battle, okay? Loss reserve, the estimation of the liability for all unpaid claims that have occurred as of a given date, including those claims incurred but not yet reported. Okay? Now remember, the IBNR is an industry factor, all right? And your insured, okay, customer, client, whatever, may be better, it may be worse, okay, or they may be right in line with the industry standard. Okay, so can't emphasize that enough. Per occurrence, maximum amount insurance will pay for all claims resulting from a single occurrence. Aggregate, the maximum amount an insurer will pay during a policy period, regardless of the number of claims. Now, if you're on a deductible program or self-insured retention, usually the per occurrence number is negotiable, and of course it varies with the premium or what you're willing to pay, but the aggregate is also an optional coverage. Okay, so for example, for us, okay, I don't buy aggregate coverage. Okay, I believe we have such a handle on our claims, and our history has shown, okay, you know, we will never get, you know, be concerned about our aggregate. So let's talk about some real numbers for us. All right, so for us, our workers' comp premium, okay, again, insurance carrier premium, okay, is I don't know, 300,000 a year, maybe a little less than that. So it's not really a big number. Our rate is 12 cents plus claims within our deductible. All right. So, you know, again, from an aggregate perspective, I'm going to be absorbing all of this on a per occurrence basis, right? And I will come nowhere near the aggregate. So if it's a $300,000 annual premium and the insurer wants to charge me 90 grand a year for the aggregate cap, okay, for me, you know, not really something I'm terribly interested in. It's not cost effective. Okay? Budgeted retention, the portion of expected losses the organization is willing and able to retain. Now, a piece to recognize here, okay, is this, is willing and able to retain. Depending upon your prospect or customer, you know, people for many companies have a little bit of an entrepreneurial side of them. And so it's not long before people figure out, hey, the higher the deductible, the less the insurance cost. Sure, to a point. So for example, if my average losses per year are 400,000 and I choose a $10 million deductible, well, the insurer is going to look at that and say, well, okay, I'm going to give you the maximum credit, you know, up to a $500,000 deductible, you know, and maybe that's, you know, a 20% reduction. Okay. However, from the $500,000 deductible to the 5 million, everybody knows you're not going to have any claims in there. So the underwriter might give you no reduction in premium or maybe a 0.5%. All right. So they get the game as well. The key is that the customer needs to understand that if they, and I know this sounds obvious, all right, but the customer needs to understand that once they choose the higher deductible, okay, you know, you hope it's a good decision. Now, that should be substantiated by loss history and loss forecasting, all right, to make it an educated decision, all right. But by and large, there may be a day that it's time to pay the fiddler, okay? They need to know that. Tolerance corridor is the marginal retention beyond the budgeted retention that an organization may choose to retain. Now, we're going to have examples of all this stuff, all right? So I will call a tolerance corridor that transitional economic formula when you convert from a deductible, okay, into insurance. Okay, you can do it as an example. Let's just call it really easy here. You got a $100 deductible. So that means at $101, the insurance company picks up from $1, above the 100 and beyond. Okay? A tolerance corridor might be, as an example, you got a $100 deductible, and then for the next $100, okay, the insured pays 50%, and then the insurance company pays 50%. And then after $200, the insurance company picks up everything else. Okay, so that's a pretty simple approach. Retention and external financing diagram, right? We're going to want to really know this pretty comfortably. A graphic depiction of an organization's financial ability and risk appetite. It includes the internal methods of risk financing, which is typically your budgeted retention and the tolerance corridor, if in fact they have one. Maybe they don't, that's an option. And the external sources of risk financing for the portion of losses that are unexpected or beyond what the organization chooses to retain. Okay, so quick question for you, just so I make sure you guys aren't sleeping, okay, is for losses that are expected, they're going to happen, okay, whatever those are, okay, how should we expect to treat those with a financial diagram or from a financial perspective? How do we handle with that? Okay. And then there's that clock ticking, thinking, oh my God, I hope somebody responds. Okay, I would expect, Charles, okay, bingo, okay, and Christine, yep, love it. Okay, so Christine, I'm panicked here. I see. Oh, okay, sorry, I misread that. So yeah, so any losses that you expect, we would typically refer to as an operating loss, and you budget for them. You pay for that out of your cash flow. Okay, because remember, if your loss is $100, okay, so whatever it is, okay, or the nature of the loss, it's $100. So I can choose to either pay the $100 myself, or I can have the insurance company pay the $100. And if the insurance company pays the 100, then they're likely going to bill me for their administration of the claim, typically referred to as a loss conversion factor or an LCF. Okay. Well, our claim volume, okay, and our overall program is large enough and sophisticated enough. And some may argue whether or not it's sophisticated. I don't know. It seems like it is to me. But what happens on that is we handle a lot of that stuff on our own. Gratefully, we are approved informally as a qualified TPA for many syndicates and Lloyd's, okay, and some insurance companies, okay, they will accept our adjustment and settlement of claims. All right. So, if I'm much rather pay the $100 than pay the insurance company $130, okay, the 100 for the claim. And if you assume, as a rule of thumb, an insurance company profit and overhead is 30 to 40%. Okay? To me, that's a pretty expensive transactional cost. Okay. So now for us, just to give you an idea of the difference, when we get notice of claim, we reach out to the party affected, okay, the same day or the next day, even if we don't have anything, okay, any good data. We'll call Jim Jones. Jim, Dave Hershey here. How you doing? Okay, I understand there was a claim. Okay, I'm your contact. Here's my phone number. That phone number is good 24 hours a day, 7 days a week. All right. So if you have a problem on Sunday, all right, I'm going to expect you to call me. Okay. So now when Jim has an issue, okay, largely resulting from a TV commercial, from, a personal injury attorney, we have recovered trillions and trillions and trillions and trillions of dollars, okay, that you deserve. Okay. forget the quality of the claim. Okay, maybe they don't deserve it, but that's not the point. Okay, Jim has the opportunity to call me and say, hey Dave, I'm thinking about this. All right, does this make sense? And by the way, I also want to make sure your phone number worked. Okay, I mean that's a very reasonable thing. Okay, so our claims that go to litigation, we're probably less than 5%. Okay, not a bad average. And I'll throw out here our experience mod. Okay, and granted, it doesn't measure everything, but it's a factor. We're a 0.57, right? So, something we're doing is either dumb luck or perhaps, maybe based upon a successful management of a program, right? So I would also suggest on the retention and external financing diagram, okay, that you would include that in your renewal proposal. Okay. Now, a lot of these things that you do, once you set up a system, okay, you just plug in a different company name, different dates, different data points, and you hit run or print, and bingo, a terrific graph pops up. And that's part of that risk management proposal. Okay. And there's that phrase, a picture is worth a thousand words. Well, depending upon this, the renewal summary, I would make the argument a picture's worth $1,000. So some people, it's not uncommon that I get calls, people looking to get involved in our program. And so I look at that and I say, I'm getting decent service with what I've got now, and when we have problems, we all address it, we solve it, and we move on. Okay. But I will share with you, it doesn't come down to a broker fee. Okay, and we are on a fee as opposed to commission. Some of the foreign placements, it's more convenient on the primary layer that we do pay a commission, but then a fee on the excess over that. But the key on that is, in the point, as long as my fee is in the realm of reasonable, I'm fine. Okay, and our fee is substantial, and so do I really care whether or not my fee, okay, from vendor A versus vendor B is, $100 grand difference? Yeah, well, probably not. Okay, because the structural cost, okay, which is substantial, the structural cost to move from insurer A to insurer B, okay, from TPA A to TPA B, or from broker A to broker B, okay, is very, very difficult, because I've got to send out, new team, data sheets, okay, to what, 70 operating offices that handle local insurance within our organization. And then you get into stupid things like you give them the email, here, print this up, put it on your, by your desk or wherever that is. So if you have a problem, this is who you call. All right. And, if they don't print it up or they delete the email, okay, it happens. Okay. I still get calls at 3 a.m. in the morning from a company that we sold 5 years ago because my name has never been updated in their system. Okay, so that stuff happens on a regular basis. Okay, so let's see. So Monica, I see here you have a question, loss reserve. Can you give me a little bit more so I can sound somewhat intelligent answering that? Okay, not quite sure where you're going with that. So we're going to have a couple of scenarios that will hopefully apply what we're talking about here. All right, so on March 31st, X industry receives a summons and a complaint for an accident. Okay? It occurred in the previous October. So immediately, let's do the quick math. All right, so October, November, December, January, February, March. All right, so 6 months, about which it knew nothing. The agent is worried that the insurance company will automatically raise the premiums due to the accident. Okay? The risk manager assures him that the insurance company
Hey, folks, can you hear me? This is Rich. Okay. Well, I'll call David and tell him that something's up. Okay, just hang on with us a second. We'll see if he answers. Hey, we're okay. Your sound went away. It's been gone for a couple minutes.
Let me see. Okay, my microphone says on. Okay.
Okay.
So, let me and then just quick and turn on.
Sure.
So I'm going to sign off.
Yeah. Okay. David hung up on me. So what you were hearing was him talking to me on my cell phone, and he's going to sign off and then come back on and see if that makes it work. Ted, do you have any words of wisdom?
Not for this. I've never had this happen.
Okay. This is probably karma because I started talking. I said, "Can you hear me?" And Dave said, "I should have said no." So now he's getting payback.
Somebody mentioned that his mic might be muted.
Yeah, that's what I'm. David, give me a thumbs up visually if you can hear me. Rich to David, give me a thumbs up on the screen if you can, or give me a hand signal.
Okay. Can you hear me now?
Yep, I think so. Yep, we're good. Okay. We're off and running. Hey, it's risk management.
Okay, I will share with everybody. That is like my #1 fear on all of this stuff, because I can't tell you all of the profound things that I imparted upon you. Okay, when my microphone went out. Okay, so at any rate, so good. So let me just check the questions here. Okay. Okay. All right, so let's see here. Okay, so let's see here. All right, so I have a bunch of questions regarding this scenario. Okay, which risk financing term best describes the provisions to which the risk manager is referring? All right, so loss sensitive is, I think, where they're headed with this. Okay, so let's move on here and see what we got. Catarama, okay, indoor playground has Okay, just so you know, I don't make up these questions. Okay, so don't hold me against some of the names. But they have an indoor playground. It has numerous claims in the past year arising out of patrons' cats biting and scratching other cat owners and their guests. Twice, a series of rabies shots and other treatments had to be administered to those injured. Numerous individuals have tripped over the cats and sustained fractures and other injuries. Catarama receives a notice that their insurance company is not going to pay for further claims and that Catarama may be responsible for paying unsettled claims. Which risk financing term describes the reason for this action by the insurance company? Any thoughts, on that from you guys? What are what are you thinking? Come on. Now, see, if we were face to face, I'd be picking on you people, okay, and pointing and calling people out so that I knew that, okay. All right, Heather. All right, expected losses. Okay, and Erica reached the aggregate. Yeah. Okay. That could be as well. All right. So again, not enough information and detail on that. Now, looking at this Catarama thing, okay, things that come to my mind. Twice a series of rabies shots and other treatments had to be administered by those injured. What comes to mind with anybody on this? Okay, come on, this is, to me, this is a key issue, okay, on defense of a claim. Communicable disease, not enough risk control in place. Yeah, okay, possible. These seem like routine losses that should be absorbed. Yep, Charles, okay, that's a possibility as well. Here's where I'm coming from on this, okay? In most states, I would venture to say all, okay? Domestic animals have to have rabies shots. So I would look at this and I would say, to the cat owner that bit, who owns the cat that bit somebody, where's your proof of rabies? And if not, well, that exposure is no different than if that cat was walking down the street out in front of their house. Or if they had a business invitee come to the house and the cat bit them. So I would look to push this right back to the cat owner, all right? So that's the difference between an insurance and non-insurance risk transfer. Okay? So now somebody's got their microphone on. I think, Rich, maybe you have your microphone on based on our conversations back and forth, okay? And if so, you could flip that off. Benji, a new producer, knows that he has sold over $3 million in policy premiums this year. However, when he looks at his commission report, it only shows 1.75 in premiums upon which he is receiving commission. Please indicate what metric the agency accountant is most likely using to commissions owed. Okay. Yeah, earned premium. Yeah, okay. That's funny. Everybody nailed that one. Okay. So yeah, earned premium. Okay. So now, if they was getting commissions on the 3 million, okay, that would be I would imagine written premium. Okay. So all right, so we're okay on that. All right. Let me see how we're doing on time. Yep, we're doing great. Let's see. Okay, insurable risks, differing points of view. Okay, so our learning objective, compare and contrast the perspectives and identify insurable risks from the point of view of both an underwriter and a risk manager. I will absolutely assure you that the perspective of an underwriter, for me, is very important, because given our deductibles and self-insured retentions, and in some cases self-insurance, all right, if it's a concern to the underwriter, well, it probably ought to be a concern to me. So, I'm not so pig-headed that, I think that only my opinion matters. Okay. I'd never turn down, an educational opportunity. Okay? Different professionals hold different perceptions of insurable risk. For example, the underwriter may perceive an insurable risk as something that has little chance of occurring and has low severity should it occur. As a risk manager, on the other hand, may perceive an insurable risk as an exposure that is often subject to loss and can negatively affect the organization. Okay. Yeah. Okay. Again, difference of opinion on that. Elements of an insurable risk: definite loss, accidental loss, large enough to cause economic distress, large group of similar exposure units, chance of a loss must be calculable, not likely to produce loss, loss to a great many exposure units at the same time. Now, remember, okay, just because I go through this thought process doesn't mean I'm going to have the same answer. All right. So, for example, earlier on, when we talked about frequency of loss, we're going to pay that out of operating funds. Right? So, yes, that in this case, option one, that's a definite loss. All right. But I'm going to choose to self-insure that. All right. Accidental loss. Okay. Yep. Probably going to shift that to the insurer. Okay. Large enough to cause economic distress. Probably going to shift that to the insurer. Okay. But you know, the other part of this is if it's large enough to cause economic distress, but there's a 0.001% chance of it happening, you know, I might self-insure that. So this is just a thought process, and depending upon the buyer, their thought process is going to be different. Now, from an underwriter's perspective, a risk shared by many. Now, this is the part, and I have to tell you, everybody knows what, stupid question. Everybody knows what AI stands for, right? Okay, and there's a big push in the industry. Right? Everything is going AI, likely to go AI. How can we use it in underwriting? How can, you know, and so on and so on and so on. Well, you know, I'm a little bit reserved on that, right? And the reason why, okay, is if we acknowledge that AI stands for artificial intelligence, my fear, and this addresses our first bullet point, that AI under the name of artificial intelligence doesn't provide the pathway that leads to the acceptability and the new standard of AI, which is automated ignorance. Okay, I can't tell you, you know, we have, you know, junior underwriters, and some of the stuff that they come back with for questions. Okay, I mean, we have corporate aircraft. All right, so although we own it by one entity, we use it as a lease through an aviation management company. So the underwriter comes back and says, well, we're not going to provide, you know, aviation liability, H&L coverage, hull and liability. I said, well, I don't want you to. And then the question is, well, how are you insuring it? And there's a side of me that said, well, it's really none of your business. Okay, you've got an exclusion on the policy. What's the issue here? You're wasting my time asking a question to which doesn't pertain to you. Okay, and that's the stuff that just seemingly, you know, goes on and on and on. Okay, now, is the risk fortuitous, meaning an unexpected and unintended, a risk that is reasonable? Well, and sometimes yes, sometimes no. If anybody has seen the movie Deepwater Horizon, okay, the Todd Jordan, the risk manager for the company, nice guy. We're, I would say, friends on that. And, you know, do you think he anticipated that to happen? Okay. So he and I actually did an educational program on coverage and the recreation of the event that actually happened and led to that loss. So if you haven't seen the movie Deepwater Horizon, I can tell you firsthand or secondhand, coming from Todd, that movie, from his perspective, was pretty darn accurate on that. So Was it reasonably calculable? Well, probably not. Okay. BP, do you think they anticipated that? I don't think so. Right. A risk large or a risk which generates enough premium paid by the many to pay for the losses of the few. And that's what leads to self-insurance. Premium paid by the many to pay for the losses of the few. Because I don't have those kinds of losses and I want to pay for my own. I don't want to pay for everybody else's. A non-catastrophic risk or a risk that is unlikely to strike many simultaneously, right? Well, okay. Well, if you have the uprising in the Mideast, okay, and during a cargo or a stock throughput policy that has no expiration date, has only an anniversary date, and you get an email saying we're canceling, the following perils in 24 hours. Okay. Well, we bought coverage for that, and oh well, insurance company, my feeling is that goes for the territory of being an all risk policy, right? So tough and actually kind of aggravating. Okay. Risk characteristics from the underwriter's perspective, a risk shared by many. Okay? A fortuitous risk, a risk that is reasonably calculable. Right? And so these are examples. Be familiar with the examples and being able to like fill in this chart if you had it on an exam. Okay? Characteristics, risk which generates enough premium to be paid by the many, a non-catastrophic risk or a risk that is unlikely to strike many simultaneous. Most charity golf events have a hole-in-one coverage. If a player hits a hole-in-one, and by the way, this has never, ever, ever been a concern for me. Okay, I'm moderately active, and man, I can't hit a golf ball if my life depended on it. Okay, if a player hits a hole-in-one on a designated hole, they win a large amount of money. The possibility of a hole-in-one is typically insured. Underwriters know that the chance of someone hitting a hole-in-one is very slim, and the premium paid by the many events will pay for the off chance that someone gets a hole-in-one. From an underwriter's perspective, the hole-in-one offer is an insurable risk. Okay, so so FYI, we've probably all encountered that one way or another. Usually when I go golfing, though, they want me to post an excavation bond before they let me on the course, and even then the surety requires me to collateralize it, so oh my goodness. James, okay, I've been to one event where a guy sunk a hole-in-one and got a truck. Okay, whoa. Okay. And the other question here from Tara, can they do that? Referring to my stock throughput policy, when they canceled coverage on a whim. Well, it's not quite a whim, all right? What they did is they invoked the war clause and broadened the exclusion, okay, to include riot and civil commotion, right? And so they didn't cancel the coverage, they canceled certain perils within the policy. All right. So, for example, once the vessel goes through the Strait of Hormuz, okay, then those perils that were excluded become reinstated. Right. Now, of course, my question is, and I'm, sometimes you just know not to ask the question. Okay. And that is, well, where's the line? Okay. Where is the line that says perils excluded and perils reinstated? Is it longitude and latitude? Okay. Is it depending upon how expensive the claim is? Okay. More likely to be the scenario. But, yeah. Okay. Some things you're not going to get answered, which is why we like self-insurance. Okay. I never argue with myself as to whether a claim is covered. Okay, it either is or it isn't, right? So, which is nice, okay? Let's see. The line is, okay, from Charles, okay, the line is about 100 feet away from where it will be covered. So, and that's, Okay, yeah, so I'm not sure if you're sarcastic, Charles, on the stock throughput. The line is about 100 feet away from where it will be covered, okay? So in other words, yes, not covered. All right. But certainly, you know, with an expensive cargo, it's going to be a battle. It's going to be, you know, litigation. Let's see. So from key points, is it reasonably calculable, severe enough to cripple? Needs additional services that can be provided more efficiently or conveniently by an insurer. Yeah, we use this one a lot, actually. So for some of our medical products, okay, and they're invasive. Okay, so as an example, everybody's heard of like an orthoscope. Okay, they stick it into your body and there's a little headlight on the end of it, so that the surgeon can see like where they're going with, you know, the little camera. Okay, well, we make the headlight. Okay, and then the little wire that powers the headlight. All right, so, you know, and there are times that, you know, heavily regulated industry, and so we use services from our insurer, who's a specialty insurer, because we need those that expertise. It's less costly than the cost of retention because of the insurance market conditions. Yeah, okay, so soft market, hard market's what we're talking about here. So in a soft market, okay, we might reduce retentions, all right, but you know, that's about it. We're not going to choose to be self-insured or insured, okay, based on hard or soft market, right? Just too much of a structural change to go in and out of those circumstances. Exceeds the organization's risk appetite. Yeah, that comes from board of directors. Okay, they make those decisions. Okay, so from our perspective, from a risk managers, okay, so you know this table. All right, and I think this is pretty straightforward. All right, I'm going to skip through here as well. An agent or broker and a risk manager. The agent or broker thinks, I need to find a market for that risk, or I may lose a customer. Man, I'm here to tell you, at least from my perspective, no. Okay, I need an agent or a broker that knows their stuff. Now, I might not like what I hear, all right, but if it's something that I can rely on and use as a tool, well, that's the value to me. Okay. The agent or broker now has the motivation to find a market that will at least offer a quote for that risk, whatever the price. Okay, maybe. Okay, and I can't, you know, the insurance market is just a weird industry. Okay, and so sometimes whatever the price, okay, it justifies my sit down with the board of directors to say, hey, we need to raise, okay, our retention, self-insured retention from 1 million to 5 million because, right? And that's the price. So we want to answer the following. Chuck is the risk manager for a fireworks manufacturer. Provide an example of an exposure that Chuck might identify as an insurable risk and explain how Chuck might address that risk. Okay. Well, okay. Anything come to mind on this? What would be an insurable risk as to how Chuck might address that? Now, remember, this is a fireworks manufacturer, right? So, products liability, an explosion. Yep, a couple of explosions. All right. Well, I think maybe not. Okay. I think when you say explosion, okay, I think of property is what maybe we're talking about here. All right. In which case, probably going to come down to separation of risk. Okay. For example, if you have one room or building that makes the cylinder, let's talk about a skyrocket, that makes a cylinder, okay, that might be paper goods manufacturing. And then the other one is where they put the gunpowder or whatever the stuff is that goes into the cylinder. Well, then that one might be a fireworks manufacturer, right? And of course, you know, from a property perspective and a workers' comp perspective, okay, those rates are going to be substantially different. When I worked for the government contractor, one of the things that we made was munitions that went into army tanks, 155 caliber, I'll call them bullets, okay, that would go into a tank, and then they launch these things. And so they made these things, in the central part of the country. And if anybody's ever been to like a kiddie land at an amusement park, they always have like a little toy, not a toy train, but a kid's train. Little kids get on these carts, and then the little train, buzzes around on a track inside kiddie land. Okay. Well, believe it or not, it's that same principle that they make munitions. Okay. And so picture, a giant field out in the middle of nowhere. And you have this little train, and the train pulls a couple of trailers, and the tracks go right into a building. Okay. And then they go to another building, and then they go to another building. Okay. Well, each building is kind of an assembly line. Right. And so the first building is less risky. That might be where people put the shells onto these little carts. Okay. Then it goes to the next building, and that's where they put the gunpowder in. Then they go to the next building, and that's where they put the top on. Right. And so that's how they separate that risk. Okay. So again, just a different thought process on that. And we actually did have a loss there, multiple fatalities. And when we got to the bottom of all of it, okay, we determined that it was suicide. Person intentionally, lit the charge, and kaboom. All these buildings have what they call explodable roofs. So the building is half underground. So if there's an explosion, the roof blows up, the charge goes straight up, it doesn't spread out. So again, risk management. What concerns might an insurance underwriter have when determining whether or not this is an insurable risk? Okay, well, first thing that comes to my mind, loss control. Okay, that is the key. Okay, so just because it's a risky business doesn't mean it's uninsurable. It means you need to understand it, quantify the risk, okay, and identify the process. Okay, huge. Oh, and Dave brought up on our example on this cyber exposure. Yeah, this, IT is not really my favorite cup of tea, just in general. When, for example, I'm having one of these classes and I lose the audio. Okay, I sit here and say, just make it work. Okay, but at any rate, so yeah, cyber is, continues to come around and around. Common risk financing options. Oh, you know what? Time for our break, actually, here. So let's hold off here. Let's do a 10-minute break, all right? And we will be back in 10. Okay, welcome back, everybody. Dare I ask, can you see me and hear me? Thank you. Big sigh of relief. Okay, so thank you. So again, can't emphasize enough, if you know, you guys have questions that pop up that's, you know, somewhat related to what we're talking about, again, no big deal, just throw them out there. All right, happy to address as best I can. Okay, so new learning objective here, explain the most common financing options available. There, and our choices are retention, contractual risk transfer, and insurance. Okay. So retention, remember, these are definitions. So should you ever be asked to define what's a retention, here's your paragraph. Okay. With the retention option, the organization makes a decision to retain a portion, if not all, of the cost of risk by financing the loss internally. Losses will be paid by using the funds from inside the organization or by taking loans. Well, we generally want to avoid the latter of the two. All right, we want to pay for it out of operating income. Okay. Internal financing is accomplished by some manner of retention or a deductible. Okay. So let's flip on here. Okay. So there's two types of retention. One is an active, and that's, you know, planned. Right. We're going to pay claims from current expenses, pay claims from funded reserves. So when we do a reserve analysis, okay, what that really does, it's an accounting process that tells us, you know, the insured, how much of reserves do we need to set money aside for? So for example, let's choose one claim. Okay, the incurred amount is $100. We've paid $20. So everybody, I think, agrees the reserve is 80. All right, well, let's say it's a complicated workers' comp claim, going to go on for a couple of years. Well, and again, just for the sake of illustration, let's say that claim's going to be open for 3 years. Well, on day one, or whenever we do the calculation, we agree we've paid 80. The actuaries are not ready to step in yet, but the insurance company says, okay, Dave, you paid 20. You know, the reserve is 80. All right, so I'm going to set money aside. I'm going to take $80 from my operating, you know, funds and set them aside in a loss fund. So when that $80 becomes due, and maybe that's in installments, okay, or maybe not, but at any rate, I need to set aside that $80. Well, then the accountants step in, okay, the actuaries, and they say, well, okay, you got an $80 reserve, okay, and that's going to be paid out over 3 years. Well, maybe it's not really going to be 80, maybe it's going to be 90. And the reason why I think it's going to be 90 is because, well, you're going to have some inflation in there, and the likelihood of this, you know, claim becoming worse, inflation being one thing, is 10%. All right, so now our claim becomes, instead of 80, okay, again, only talking the reserve, okay, $88. Okay, so I need to set aside the $88. All right, so that's what we're talking about from funded reserves, okay, and future liabilities. We're going to pay claims from unfunded reserves. The potential liability for payment has been entered into the organization's accounting records. However, funds have not been aside to pay those claims. Okay, so let me just go through this again. Right, so the reserves, okay, is the money that's been set aside. What they're talking about here is the money that comes in on Monday, turns around and goes out on Tuesday, okay, to pay a claim. The reserves are the amounts that are set aside for the end of the year, okay, or whatever your accounting period is. Setting that money aside, knowing it's going to be paid out in the future. All right, so that may not be planned. All right, so in other words, the $80, okay, the 80 might be planned, probably not. Okay, remember the 20 probably is planned, but the 80, the inflation, making it 88, plus the degree of unlikeliness that the 80 was accurate. Maybe it should really have been, or history has shown those types of claims increase 3%. All right, so that portion is typically not funded and should be and will be funded at some point in time during the accounting cycle. Right? Passive retention, okay, and boy, do we not like these. Okay, these passive retentions will almost always result in a meeting. Okay, and sometimes those meetings can be comfortable, okay, and sometimes they can be really, really uncomfortable. Okay, so to be comfortable, okay, you got to show the math. Okay, how did you come up with your retention? Okay, and how did you decide what not to cover? Okay, in terms of a limit. Okay, and if all the math is there to support it, well, okay, then that's a less painful meeting. However, if the meeting is a response such as, "Man, I never thought of this," okay, you know, that could be very uncomfortable. Right? So failure to identify exposures or sources of loss. Okay? Well, for what we do, and we are a diverse company. I mean, really diverse. And so, that's probably the thing that concerns me often is, well, as recently as 3 months, 4 months ago, um, I get a request through somebody in my group, and we have a department actually. So somebody in the department gets a request for a certificate of insurance, along with a questionnaire, okay, to participate in an OSIP, okay. And I'm thinking, well, wait a minute, time out here. We're a manufacturer. Okay, I don't get this. Why are we getting a questionnaire to participate on a GC's OSIP, okay, or CSIP? So, you make a bunch of phone calls, they don't call you back, you follow up, it's telephone tag. So over the course of 2 weeks, I find out that this particular branch of an entity that we own, okay, has a team that specializes in going into new building construction and installing this equipment. And I'm like, oh, okay, well, when did that start? Oh, we've been doing that for about 6 months. Okay. Well, of course, that kind of changes everything because, these installations are in residential condos. So now the underwriter is, oh, wait a minute, we don't want to cover, residential construction. And then you go through the whole thing as, well, it's not construction. That's what the general contractor is for. Okay. We install one piece. It's no different, okay, than, us providing, thermostats for the air conditioning. We go in, we hook them up, done, out. Okay. And so after about 2.5 months of explaining that, they agreed. All right. So, again, the known exposure is one thing. Not knowing the exposure is very, very, very difficult because you have people, and a lot of times when we buy a company, it's a small outfit, and somebody in charge there has always been calling the shots when it was their own company. And so now when it's not their company and it's a company that we own, okay, they just insist on doing it the way they used to. And it's like, well, no, we're on a different bus now, right? And that's hard. That's really hard. Okay. Let's see. Okay, so good. That's looking at another question. That's an IT issue. Okay, great. Contractual risk transfer. Contractual risk transfer is the reduction of an organization's liability exposure through the proper structure of contracts and other agreements. It's transfer of financial responsibility that uses external funds to pay for the loss. So when we talk external funds here, we're talking about make the other guy pay. Okay, I mean, that's really kind of what it comes down to. So a couple of things, and we have some standardized provisions that a lot of entities are exposed to. For example, temporary labor. Well, if you get labor from like a temp agency, okay, for, I don't know, let's just say for 3 months or so, unmodified, most of those, and I'll call them a purchase order, contract, whatever you want to call it, okay, is provided to us from the temp agency. And it says that we will indemnify and hold harmless the temp agency for any and all, claims resulting from any of their supplied labor, okay, or anything that they do. So, again, this goes on below the radar screen. I had no idea we even do that until we have a claim. So we have temp labor. We have 3 college kids that were supplied to us from a temp agency, and it's shift work. Okay, so they're on the second shift, so they punch out at 11 o'clock. And a lot of times with factory work, okay, the 10:55, 10:56, 10:57 p.m., people start gathering at the time clock with the time card in hand. And when that clock hits 11 o'clock, it's bing, 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 and everybody's out. Well, okay, these are college kids. They're standing at the time clock waiting to punch out, okay? And, one makes a wisecrack, the other one follows, and it becomes, and I mean this as a, an accurate observation, they were goofing around, okay? So one pushes another one who wasn't expecting it. That person falls back and bumps into one of our employees. So our employee falls over, she breaks a hip, she's a diabetic. This gets into a $400,000 workers' comp claim. Bing, in a second. And guess what? So I go back to the temp agency, okay, with, my tray looking to collect the cash to get reimbursed. And then I get presented with, oh, well, here's our agreement. So then I reach out to our entity and I'm saying, folks, what the heck? You have internal legal. How did this happen? All right. So these things happen, often, and you got to dig deep. You got to ask the questions. All right? So exculpatory agreement, let's talk about the types of contractual risk transfer. We're all familiar with waiver of subrogation, I think. Exculpatory agreement, okay, meaning you're going to carve out something in specific that's not going to be covered. All right. So an exculpatory provision of our stock throughput policy is war. Okay. War is not covered, carved out. Limitation of liability. This is priceless. I see this with a lot of broker fees, and I'll say the old days. Okay. So back when people knew who Led Zeppelin was, or the Who, or Pink Floyd, okay, back in those days, all right, brokers would execute a fee agreement and we're off to the races. Okay, end of story. Well, now they're putting in the limitation of liability, saying, as an example, we will place the following lines of coverage. Bing, bing, bing. However, right, if there's a problem, we, meaning me, I agree not to hold the broker for responsibilities over and above, let's say, $100,000. Right? And in this case, let's call it $1 million. And I look at that and I kind of laugh, okay, because there's no way I'm going to agree with that. And I said, and my response on that is typically, if the broker is placing, 500 million of limit, but they're only responsible for 1 million, okay, in terms of an error. Well, I'm going to look at them and I'm going to say, well, okay, if you've got no accountability for anything above 1 million, then I'm not going to pay you for the placements of the remaining 499 million of coverage you're placing. I mean, think about it. They want to be compensated for not having the exposure. I'm like, that doesn't make sense. So we'll typically, get over that with that type of an arrangement. Hold harmless and indemnity agreement. A lot of times people look at it, hold harmless and indemnity is kind of the same thing. Well, they're not. Okay, an indemnity agreement, okay, is a third party, and a hold harmless is a first party coverage. All right, so those are a little different. Right? Waiver of subrogation, pre-event agreement to waive the right to seek recovery from a responsible party's insurance carrier. Okay? So kind of important on that. Owner of a two-story building requires tenants to provide him with a waiver of subrogation for any damages that occur in the leased units, which are the result of his actions or inactions. This is a typical lease provision. Okay? So again, we see these things all the time. The thing that I would want to stress with you is if you see a requirement for a waiver of subrogation, be darn sure that you understand, I mean, crystal clear, not that you think that you understand, but you really understand. Why? What's the relationship? Who's doing what? Okay. Now, one area that I see often overlooked, I mean, probably 80 to 90% of the time, all right, when the exposure exists. We've all seen situations where, you know, you have a business owner, okay, and it's his business, but the business is a tenant in a freestanding building. The owner of the building is the owner of the company. So, you know, maybe the name of the company is ABC Manufacturing, and the landlord is XYZ, real estate, but it's the same person. Well, interestingly enough, okay, one, a waiver of subrogation may or may not apply. That would be worthy of a deeper dive. But where I usually see the problem on this is workers' comp. Okay, and you're thinking, workers' comp, you know, who cares? I mean, that, you know, they're not in the facility yet. Yeah, but you know what? Okay, there's 5 examples when an injured employee can choose to forego workers' comp and sue the employer. Okay, and so one of those 5 is in the event that the business, okay, and in this case, if it's owned by the same person, is involved in any other real estate exposure. So what you end up faced with is you have a person that slips and falls in the parking lot. And I'm assuming here the parking lot's owned by the building owner, all right? You know, because that's the real estate that surrounds it, all right? Well, in that scenario, okay, the workers' comp that would have applied would have been the employer, the manufacturing company. The employee slips and falls, okay, and then says, you know what, I'm not going to take workers' comp. I'm going to sue, you know, the landlord. I'm going to choose that. Now, recognize some states, okay, workers' comp applies when the employee is on the premises of the of the employer, and some not until they get in the front door. All right, so that'll vary a little bit based upon, you know, the statutory provisions, but that's certainly an area to look at and dig deep and be sure you understand that. An exculpatory agreement is an arrangement whereby one party agrees to absolve a second party from liability for a particular loss, even when damage or injury is caused by the negligence of the second party. Sometimes these are not enforceable. All right, so you need to check based upon what are referred to as anti-indemnity states. You can do a Google search and get an arrangement or get a list of the anti-indemnity states, and those are the ones that are probably not going to allow an exculpatory agreement. Richard and Joan live next door to each other. Joan has a pool in her backyard. The pool is surrounded by a fence. Richard has a tall oak tree in his backyard with branches that extend over Joan's pool. So almost every day, Joan must skim leaves from Richard's oak tree out of her pool. Even worse, each spring, she has to spend a lot of money, spend a lot of time backwashing the filter due to the pollen, which is again caused by Richard's tree. One day, Richard tells Joan that he was planning to cut down the tree but he is worried about the limbs falling and damaging her fence. Joan is so happy that the tree will be gone that she quickly agrees that she will not ask Richard or his insurance company, that's a key piece here, to pay for damage to her fence when the tree is being cut down. Together, Richard and Joan write an agreement expressing the terms, and they both sign the document. Limitation of liability in a contract limits the liability of the company to some proportion of its fee or defined dollar amount. All right, so again, these limitation of liabilities, these appear, okay, so for example, how many times have you gotten contracts from your customers say, hey, we're about to sign this contract, and will you take a look at the requirements and make sure that we're compliant? And you get maybe one page of the contract, or maybe section 11.7, which is the insurance requirements, right? I mean, that's pretty common, all right? When that happens, okay, you should also be saying, wait a minute, okay, this is part of it. Customer, please send me the limitation of liability clause and the, right here, the limitation of liability and the hold harmless. You want the insurance piece, you want the limitation of liability, and you want the hold harmless agreement. I would also add, to put these in context and to really evaluate the risk, make sure, okay, you get the scope, okay? Who's doing what? And it'll do a quick and an easy job of explaining to you, what everybody's responsibilities are. A developer sued the oh, good question here, wait a second, from Charles. I was always told exculpatory agreements are frowned upon by the courts and are difficult to enforce. Has that been your experience? Okay, and the answer, Charles, is yes. Okay, that has been my experience, subject to the following two exceptions. One, not an exception or an assessment. One, sometimes courts will look at the two parties and presume both parties, one, may have had a benefit from that arrangement, but more importantly, they are experienced professionals. Okay, and so in those scenarios, I have seen courts said, you know what? Okay, yeah, we're going to make the agreement sticks. The other is the jurisdiction, and typically, and again, maybe 99% of the time, if the contracting party, the person that designed the contract, is a Delaware corporation, Delaware typically says the deal's the deal. Whatever you signed off on, so be it. What the courts have typically been trying to do is protect the small mom and pop contractor against the big GC. So if you're, a Kiewit construction company, big outfit, and you're, an electrical contractor with 3 employees, and the electrical contractor is responsible for any and all losses resulting from the construction project. Well, okay, that's not really a fair deal, because the small contractor is looking for the business, and they don't have the sophistication that maybe a Kiewit does. Okay, so so generally, yes. Okay, exculpatory agreements are frowned upon by the courts, right? But the intent is to protect the little guy from being squeezed by the large GCs, right? So good point. And a list of the anti-indemnity states will also share with you those states in which exculpatory agreements are generally not honored, right? So hold harmless and indemnity, okay, assumes the financial consequence of the liability inherent in a situation, thereby relieving the other party of that financial responsibility. So let's talk about an example. Again, we're going to see these often in our travels, and be sure you understand, okay, so again, here's the definition, but this, okay, example will be spelled out for you when you read the scope of the contract, right? Which is usually, I don't know, first or second paragraph of a contract. It outlines who's doing what. And you can't really evaluate a hold harmless or indemnity agreement unless you understand who's doing what. Okay, so GC wants to be sure that he shifts as much financial responsibility as possible for claims to another party. As such, subcontractors he uses are required to sign an indemnification agreement before they can perform work for him. The subcontractors sign this form, agree to be responsible for their own negligence and or fault, and for any negligence that the GC contractor share jointly. Okay, and this might be an example of a contract that would not be enforceable in court, because again, the small contractor, either they sign the agreement and don't get or don't, and if they don't sign, they don't get the work, and if they do sign, okay, well, you know, all of a sudden their insurance, the small contractor's insurance company, might be picking up more exposure than they anticipated. A subcontractor working for the GC installed a floor. Days later, a flaw in the floor's installation caused someone to fall. While both the subcontractor and both the GC and the contractor are deemed negligent. The execution of the indemnity agreement means the subcontractor will be held financially responsible for the financial consequence of the loss. Now, in principle, sure, that's great, all right? Not a problem. That's what it was intended to do. I will share with you, and you can find this on the internet. A loss that I had was the Pennzoil refinery claim in Rouseville, Pennsylvania. Okay, you can find that on the internet. A $70 million loss. All right, and one of the attorneys, you know, signed off, and sometimes attorneys can be a tough group of people. They know it all, which includes insurance, and some of them do, not a problem, all right? And I'm talking about contractual casualty insurance, not personal injury insurance, all right? So what happened is one of our attorneys executed the contract and said that we agree, okay, whoops, sorry, here. We agree to be responsible for their own negligence and fault, and for any negligence that they and the general contractor share jointly. They signed that, okay? And it gets back to that clause, okay, for claims resulting from or arising out of. Arising out of is the far more general exposure. Resulting from is far more specific. And if there's no direct causal relationship to the work, the small contractor walks, right? So what happened is, you know, there was a significant explosion, multiple deaths, okay, at the refinery. We had nothing to do with it, absolutely nothing to do with it. And we ended up kicking in, I think it was 18 million to the loss, okay, because somebody signed an overly broad hold harmless and indemnity agreement, and we were a Delaware corporation. Okay, court said, you know, oh well, you know, you should have thought about that before you signed it. An indemnity agreement may take the form of an agreement that simply transfers the financial consequences. You pay on my behalf, okay? And we love pay on behalf forms. Okay, while a hold harmless agreement attempts to require the indemnitor to assume much more responsibility, perhaps even including defense obligation. Yeah, okay, hence the third party approach. Okay? So again, understand this stuff. Just like when I was making the joke, not really a joke, but the difference between agents that don't, or at least some, that didn't understand workers' comp versus employer's liability. Okay? Understand the circumstance. And just like when we get a claim in, as I told our claims people, I said, look, you know, some of these things that you get, the description is terrible. Okay. So you need, part of the thing is, before we submit it to our insurer, TPA, or whomever, okay, you need to be darn sure what happened, and it has to be as clear to you as watching a video, all right? I mean, and if it's not that clear, you keep asking questions, because by the time you get to the finish line, it really might not be our claim, right? But you've got to understand it. So on a going in basis, you need to understand this. So here's what I would consider to be an interesting twist, okay, on a renewal. Provide a half a dozen, okay, or maybe 3 examples of hold harmless agreements, and just and I'm sure you can find them on the internet, and share with the prospect or the renewal as to why it's important to understand these. And you take that example and you bring it right back to your insurance policy. Okay, that's why these types of illustrations can be really helpful, because a business owner will certainly understand hold harmless and indemnity requirements. They will understand those far more effectively than they will insurance terms and conditions. The agent or the broker acts as that intermediary, interpreting the everyday exposure of the business owner and why or why not. Okay, it relates to insurance coverage, and maybe it's as simple as an endorsement. So, oops. Insurance can be defined as a promise of compensation for specified losses in exchange for payment of premium. Okay, or maybe a broken promise. I don't know. It depends on how many times you've refuted claims or losses. It's important to note that insurance is not a transfer of risk. It is a contractual responsibility to assume the financial consequences of the the risk. Okay? Right? Remember, okay, key piece. So best example is perhaps, you buy $1 million worth of liability insurance and the loss is $4 million. Well, the insurance company, we've all heard this phrase, okay, pays the limit and walks away from the risk. And they offer no defense cost, nothing. And of course, whether defense costs are included inside or outside the limit, different issue, all right? But that's a reinstatement, okay, or an illustration that it's not a transfer of the risk, it's the financial obligation to pay. Okay, again, assuming coverage, okay? If it was a transfer of risk, well, then the insurer would be responsible to handle the transaction above the insurance limit. But it's not. They don't pick up the risk. They quantify the risk in exchange for premium and a defined financial benefit. Okay, Wilson Designs hires information technology company ABC to perform upgrades to its data management system. This is one of my favorite subjects. Okay? One of ABC's employees is walking across Wilson's office when he trips over a rip in the carpet and breaks his leg. The ABC employee files a workers' comp claim. No surprise. The insurance company pays the claim, okay, and then tries to recover its payment from Wilson's Designs. Okay, the insurance company is unsuccessful because the parties have signed an agreement. Okay, right. So, come on, somebody answer this. Waiver, yeah, oh yeah, you guys nailed it. All right. Now, here's the interesting thing. Okay, I want to say maybe a year ago. Okay? It doesn't have to do with workers' comp, but let's talk about how an IT company performs services. Well, if let's say an IT company comes in and they're, a certified Microsoft, outfit, right? And so in the process of doing the upgrade, they mess up, wipe out all of the information, or, they have to restore all the information, and it takes 3 days to do that. Anybody remember the claim or the occurrence from a company called CloudStrike? Okay, right. I got stuck in an airport for a day and a half because of that. So You know, I don't know what the dollar amount of the upgrade was for that they were being paid, but the consequential losses associated with all of that was unbelievable. And so a lot of times, you know, we'll get, you know, requests from sales reps. Dave, come on, how come, you know, you're just being, you know, tough, you know, on this guy. You know, the contract is only $1,000. Okay. You know, and you're asking for this, that, and you know, all this stuff. I said, well, yeah, but if something goes wrong, okay, it's going to be a lot more than $1,000. Another real scenario. What we had was a company that was hired to come in and inspect an oil storage tank. Every 10 years, you know, you got to drain the tank. Somebody goes, climbs into the tank, they test the thickness of the steel, the condition of it, and so on and so on. All right. And so the manager of the terminal, okay, calls George. Okay. George has been inspecting these tanks for a million years. He knows every one of these tanks like the back of his hand. Well, George does a drive-by. He doesn't even, they don't even drain the tank. He doesn't go in and inspects it. Okay. And he gives us, the terminal manager, an approval sheet saying, yep, tank's fine. We use that approval sheet or the pass, okay, as part of the operating permit process that we get from the state. Well, 6 months after that test, the tank ruptures. Right? We got a $7.5 million claim in about 10 hours. So I'm looking at this going, hey, no problem. Okay. This is TV show. I sit back and watch. Okay. And the inspection company, okay, has a problem. Lo and behold, don't I find out, okay, that our terminal manager signed a purchase order that contained a limitation of liability. And the limitation of liability was for the cost of the inspection, which was $20,000. And I'm like, you're gonna be kidding me, right? So this stuff happens, you know. Photocopier is leased for 60 months for $500 a month. Photocopier somehow catches fire and burns a large portion of the building. The amount of the damage available from the leasing company would be insufficient to cover the needed repairs. The company would not be liable and for more than $30,000 because of the clause in the lease limitation of liability. So our objective here, explain the retention and external financing diagram. Risk financing. Risk managers and supporting insurance professionals face the same challenge. How to determine the right mix of internal funds and external funds. Okay. The key to that process is an understanding of an organization's risk tolerance. Now, a risk tolerance, just so you know, that may change. Okay, in other words, some companies might start at a low risk tolerance and then grow to be a very large risk tolerance based on their comfort and successes of the risk management program. Okay. So risk financing, setting deductibles amounts, establishing limits of liabilities. Now, everybody's heard, you know, the question, well, what's the right amount of umbrella coverage or excess coverage? Well, typically, current net worth of the company plus retained earnings plus in future net income for maybe 5 to 10 years into the future. That's a good starting point for your limitation of liability. Determine which insurance coverage to purchase and which ones to retain. Okay. Risk financing. Risk managers look for ways to visually depict an organization's financial capacity or its risk tolerance. One visualization technique is the risk retention finance diagram. Risk retention and external financing diagram is a graphic depiction of an organization's financial ability and risk appetite. It includes internal sources of risk financing as well as external sources. And bingo, this is what I would look to include on every single renewal or prospect. People don't see this stuff. Okay? No matter what, most people, I think, are more impacted by easy to understand graphics. So this, okay, all right, so here's my total amount of the claim. Okay? This is my frequency. So for stuff that I know is going to happen, I'm going to pay for this out of my cash flow. When it exceeds my cash flow, it then goes into external financing, umbrella coverage, risk tolerance corridor, all right? Well, okay, maybe at this point I say, okay, how much of this, okay, beyond individual claims, okay, do I want to absorb? Okay, so maybe this is my $100, and then I say, yeah, but you know what? I can absorb a little bit more than $100. I can absorb 120. All right. However, whether it's 100 or 120, I say, under no circumstances can I absorb, at the end of the day, lock, stock, and barrel, all claims, all responsibilities that I'm responsible for. Can I afford more than 500,000? And that is my aggregate excess coverage. Okay. So this I would look to include in a renewal. Again, a nice graphic, and you set it up once. Okay, you're done. You're over with. All right, you can just keep using it over and over again. Okay. Risk managers of a framing company knows it will typically cost the company $7,000 annually for merchandise damaged in transit, such as chipped, broken, or water damaged wood and broken glass. The damage is broken down as follows: complete a retention risk external financing diagram and explain your answer. All right. So 20 of individual claims between 50 and 100. That's this. Oops. 5 damages that cost 100 to 250. That's this. Remaining balance is damage over 250. That's this. Reinsurance. Okay. Okay. We're running a little bit behind here. You guys are talking way too much. Okay, stop with the stories. Let's try and stay focused on that on the content here. Quick aside, I really enjoy doing this stuff. So sometimes if I get a little carried away, I apologize in advance. But I always want to make sure you get the the best value for these types of programs. So our objective is to describe the basic types and forms of reinsurance and apply their use to real-world scenarios. Reinsurance defined, right? So let's know these definitions, okay? And these are straightforward, okay? This is just a memorization process. So I'm gonna leave that to you, all right? All right. Seeding company, more definitions, right? So seeding company, this would be, as an example, Chubb, Liberty Mutual, AIG, Travelers, and so on. The reinsurer, okay, is going to be Gen Re, Swiss Re, those types of companies. And the ceding commission is going to be, Gen Re or Swiss Re paying Liberty Mutual to give them the business. Okay, no different than the producer. Cession, transaction that transfers liability from the ceding company to the reinsurer. Retention, this is the amount that Liberty Mutual is going to absorb. Retrocession, okay, is the transfer of the liability to another insurer. Okay, so sometimes you have, especially now in the property market, shared and layer programs. And so retrocession is that transaction that transfers liability from the reinsurer to another insurer. So when we talked about, or you've heard, the California wildfires, well, there are several reinsurers, that were involved in that. And even on our property program, I think we have, I may be off, but I think we have 22 different insurance companies to give us the capacity that we need, right? And so when some insurers buddy up with another insurer and they share in a block of coverage, that's retrocession. Okay? Treaty insurance and facultative. Treaty, okay, is an advance agreement, okay, between the reinsurer and the retail. So Liberty Mutual and Swiss Re, okay, that's what that is, all right. Facultative, well, okay, that's when the Liberty Mutuals of the world or whomever say, I'm not sure I really like this risk, but you know what? We write so much other coverage with this particular insured, okay? We don't want to lose them as a customer. So we're going to reach out and find another insurance company to step in, okay, and pick up that exposure, because that's not normally part of our appetite. Pro rata reinsurance, okay, also known as proportional reinsurance. It's an agreement to share the insurance coverage, and that's going to vary by percentages. Somebody might be 80-20, 50-50, whatever it is, right? But it's a defined sharing amount, and it's done in advance of the contract. Reinsurer gets an agreed percentage of the premium, okay, less the commission, okay, and pays the percentage of the losses, okay? So if you pick up 20% of the premium, you're going to pick up 20% of the loss. Quota share, primary or ceding company cedes a part of every exposure, right? That is a defined dollar amount sharing. Surplus coverage, the primary or ceding company cedes to the insurer a pro rata share of the risk. However, and this is the key, reinsurer only pays its percentage of loss when the amount exceeds the net retention described in the treaty, thus falling into the surplus. Okay, so you want to know these two types, I mean, really well. So here's some illustrations. So the ceding company, all right, so this is our Liberty Mutual, this is our Swiss Re. So Liberty keeps 40%, okay, Swiss Re keeps 60%. Okay. Now in a surplus share, all right, here's my deductible, okay. Now here, as an example, right, no deductible. So I'm responsible for $250. Then the ceding company is 40 and the reinsurer is 60. All right. Now, this could be an insurance company, and then maybe my deductible is another box down here. Right. So it doesn't really matter too much. Right. Non-proportional reinsurance, excess of loss reinsurance, also known as non-proportional reinsurance. It is an agreement to share a specified loss. Okay. So I would reach out to a reinsurer and say, here's my exposure, and I want, 50 million of limit from you, okay, with the following criteria. Okay. So that's not common, but it's also not uncommon depending on the line of coverage. And these are the categories: excess per risk, excess per occurrence, aggregate excess of loss. Okay. And you're going to want to know these definitions. Okay. Types of reinsurance. Let's take our break here. All right. We'll come back. And before we start the next section, we've got a couple of more slides here, and then we'll move right into the next piece. All right. So see you on the half hour.